The World Bank just produced its Global Economical Prospect Report, and it paints a very worrying picture. They are predicting that the global economy will experience its weakest half-decade in over 30 years. And they've even got a name for it. They're calling it the decade of wasted opportunity. But what does this report actually mean for folk like you and I who continue to invest each month into our low-cost ETFs? How will this slowdown in growth affect us and our retirements? Does this mean we won't be able to retire when we want to? Will it affect your job and maybe even your mortgage? Well, the short answer is yes to all of those questions. But it isn't all doom and gloom. In fact, if you plan correctly, this could be a golden opportunity. This report indicates that we are heading to the worst half-decade of growth in over 30 years. For 2024, the global growth rate is expected to slow down further to 2.4%, following its decline from last year in 2023 of 2.6. In layman's terms, it means that the growth rate of the world will be worse this year than it was last year. However, the report does offer a glimmer of hope because it anticipates that things will marginally improve in 2025 when growths go crazy at a 2.7%, which is still substantially lower than the average growth rate we had from 2010 to 2020. No matter which way you paint this, the World Bank is basically saying kiss goodbye to the average market returns for this current decade. This will massively affect how our retirement and investing accounts perform in the coming years. For example, if you invested $500 each month for 30 years with a typical 10% market return, in 30 years you can expect to have $1 million. But if 1/3 of this 30-year time period was this current decade, things start to look bleak, and this final $1 million figure drastically drops. If you averaged a 7% return on the same investment calculation, that $1 million pretty much cuts in half. So what can you do about it? Well, this report says that the slowdown and the growth numbers come down to several factors. They say that the ongoing war in Europe is a driving factor along with the recent Middle East conflict. They say that these wars pose a significant risk, particularly affecting energy prices and in turn affecting inflation and economical growth. If inflation stays high, interest rates will also stay high, and businesses and people alike will start to get squeezed even further. Any buying power, a business or future growth opportunity that may come will be much harder to manage and capitalize on, which is why the World Bank expects growth to slow down significantly. The report also states that geopolitical tensions present a new challenge in the near term, which will also lead to slower growth in a lot of Western economies. Constant changes in leadership in established nations just bring a lack of consistency, and it adds even more uncertainty to the markets, and businesses who are already squeezed may not act on a potential growth opportunity. And it gets even worse. The percentage of world growth used to massively rely on China and other emerging economies. These emerging economies used to add a few pips in terms of growth to the overall percentage, but even that looks very glim. Developing countries are expected to grow at just 3.9% in 2024. And by the end of this year, 1 out of every 4 developing countries and about 40% of countries on low income are looking to be more poorer than they were on the eve of the COVID pandemic in 2019. If you think about it, that's 5 years of wasted opportunity, hence the name the World Bank came up with. And while this is slowing down, advanced economies aren't looking too great either. Western economies are set to slow to 1.2% this year, down from its 1.5% growth last year in 2023. All of this uncertainty and potential slowdown represent a huge problem for investors. But, like I said, if you plan, this actually warrants amazing news, provided you can do just one thing. Typically, as investors, when it comes to investing just $1, we want something like this, a straight line, because that way we are getting constant growth every single year. But the problem is, this only works if you already have that $1 million from day one. Reality is, you don't. So what we have to do is we have to invest every single month. And every time we contribute, the market does something like this line. Yes, it's gonna be wavy or whatever you want, but you are gonna buy it no matter what, and it will eventually reach here, whichever the maximum amount of the market return will be in your time period. What this actually means is that your average price is going to be somewhere around here, meaning that you have actually not made whatever this figure is. You've actually only made about 50% of the overall market if it does somehow ever do a straight line and reach its maximum potential. What would be better for us as investors is if we could bring this average price somewhere down here, and we have a way to do that. For example, let's say this is 30 years until we have retirement. We've said we're going to invest $500 on every single one of these lines every single month. The World Bank just told you that growth in the first 10 years, 1/3, is expected to slow down, which means that our return will probably be something like this. The maximum figure is still going to be whatever it's going to be in the future. You can't predict that. You can't play with that. My point here is, us as investors, we need to be buying as much as possible if things look cheap. So in response to this article, if things slow down and growth of the overall market happens, it's welcome news. I'm not retiring anytime soon, so provided I can buy my ETF of choice every single month, this is great news. If the world economy slows down, I can get a better average in my investment. We don't know what this figure will be in the future. We can't change it. All we can do is buy as much as possible when things are cheap. There really is only two things we should be doing as investors. One is religiously investing regardless of what the World Bank says. And the second thing is to get the best possible return. And to do that, you have to aim to beat the overall market returns. Many videos say this is not possible, but I am telling you right now, it is very possible with the exact same strategy. And if you want to learn the easiest way to implement this strategy, watch this video here because it will massively impact your future investments.